Good morning, everyone. I am Dr. Taru Maheshwari. Today we are discussing about the accounting concepts and conventions. So, what is accounting? Accounting is basically the science and the art of recording books of accounts. So, before recording books of accounts, there are some assumptions and conditions on the basis of which the statements of an entity are prepared. So these are the concepts which are adopted by the organization, or we can say that these are the assumptions which are used for preparation of financial statements such as income statement and balance sheet, so that there is a uniformity in reporting. So let's begin with the first accounting concepts. The first accounting concept is business entity concept. Business entity concept state that the business is separate from its owners. So when we do the transaction in the business, we do the transaction on the basis of business only, not by taking businessmen into consideration. So the main intention of this concept is to keep the business transactions keep away from the influence of personal transaction of its owner. That is why the capital is different from the drawing, and we consider capital as the liability for the business. The next concept is the periodicity concept. What this concept said that the entity or the business needs to carry out the accounting for a definite period. Usually it is a financial year which consists of 12 months. So whatever the transaction is done in the business, it is considered for an year only, and the year can be Holi to Holi, Diwali to Diwali, or from January to December, or from April to March. The next concept is the money measurement concept. The money measurement concept states that the transaction which can be measured in monetary terms are only recorded in the books of accounts. So the non-monetary transactions cannot be recorded in the books of accounts. For example, if a teacher is teaching its own student, that is not recorded in uh, own child, that is not recorded in the books of accounts. The motivation, which plays an important role for the business, but it is still not transacted in the business, and it is not recorded because only money transactions are recorded. Next concept of accounting is the accrual concept. According to the accounting system, there are two types of accounting. One is cash accounting and one is accrual accounting. So, as per this concept, the transactions should be recognized in books of account only when they occur and not on the case basis only. So, all the transactions which are done on credit, which may have impact for the another year, but still they are transacted in this particular year, will be recorded in the books of accounts. So in the accrual concept, we also take into the consideration the transactions which is done on the credit basis or which have an impact in the future. Next concept is called as the matching concept. As per this concept, all the expenses which can be matched with the revenue of that period, that is only recorded into consideration for the financial reporting. For example, we can say that there are so many adjustments like outstanding expense, prepaid expense, unearned income, accrued income. So all these transactions take place in the books of accounts. Why these takes place in the books of accounts? Because of accrual concept, means all the transaction of which have taken place in a year must be matched. So the next concept is called as going concern concept. According to this concept, the financial statements are prepared on an assumption that business will go for a longer period of time. So it says that if we assume that the business does not have the intention to liquidate or curtail its scale of operations. That's why we take depreciation into consideration. And we consider that the business will go for a longer or infinite period of time. And that is why we take, when depreciation we calculate, so we take cost minus scrap value upon number of years. So that number of years shows that it is, the business is going for a longer period of time. Next is the cost concept. So there are two types of cost which are always there in the books of account. One is the market value and one is the cost. This is at book value or the acquisition cost or the historical cost. So, as per this concept, the asset should be valued only at the historical cost or the acquisition cost. Again, we are taking the example of depreciation. So, when we calculate depreciation, we calculate it as cost minus scrap value upon number of years. So, when we take this cost, so this cost is the historical cost, and that is why we take it into consideration. So, always in the business, we take historical cost into consideration. The next concept is the concept of realization. So concept of realization says that any change in the value of asset is to be recorded only in the business when it is realized. So when it is realized, it has an impact in the books of account. So it does not say that when an order is made, it is to be recorded. It is only recorded when the business realize it or it is converted into cash. The next concept in the business is of dual aspect concept, or we can say that it is a double entry system. For every debit, there is a corresponding credit, and all the transactions in the business is done on the basis of double entry system. So this is all about the concept. Now we are coming to the convention. So the basic difference between the concepts and the convention is that the concept is the assumption of the business, whereas the convention is the guidelines or the customs which are used in the preparation of financial statements. So basically there are four types of convention: conservators, consistency, materiality, and full disclosure. The first convention is the convention of conservators. So, as per this concept, accounting should anticipate or make the entries for the all the possible losses, not for the income. That is why we always enter into business various provisions for taxation, provisions for depreciation, and also we take, while doing the inventory valuation, the cost value or the market value, whichever is lower, because we anticipate loss but we do not anticipate the profit. Next is the consistency convention, which states that whatever the policy the company or the organization is following, it must be consistent from one period to another. It does not mean that it cannot be changed, but it should be consistent for some year. For example, if we take the depreciation into consideration, it can be charged with the straight line method or it can be charged with the diminishing method. So, whatever the concept the business is adopting, it must be continued for some years to come. That is the consistency concept. The next concept is the concept of materiality, which states that the only the significant information is to be recorded in the books of accounts. The insignificant item cannot or should not be disclosed in financial statement, and whatever is material or immaterial, that depends upon the accountants and all that. So for a tea businessman, pesa is also very important, while the manufacturing business, they may ignore or they can take their figures in the round figures. This is called as the materiality concept. The last convention is the full disclosure. So record should be fully and fairly disclosed in books of account. They must be honestly prepared and sufficiently disclose about the information that is of material interest to the proprietor and the potential creditors and investor. It must be disclosed fairly as well as fully. So that is all about the concepts and conventions about the accounting, on which the basis of accounting is based, the assumptions and the traditions on which the transactions can be done. Thank you.